A family trust can be a great vehicle to help you build wealth because it's got a lot of benefits from a tax, asset protection, and estate planning perspective. And in my own personal situation, I use a family trust and I have many clients that do so as well. So I think this puts me in a good position to run you through some of the pros, some of the cons, and some of the high-level uses of a family trust. But before jumping in, I do want to say that a family trust is definitely not appropriate for everyone's situation. So on top of watching this video, go out, do some extra research, and get the specific advice you need about your own circumstances. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we are talking about family trusts. Firstly, let's kick this one off by defining what a family trust actually is. And it's pretty simple. A family trust is a structure that has a trustee that holds assets for the beneficiaries. And there's different types of trusts available out there, but today we are focusing on a family trust. A family trust is a form of discretionary trust which has made a family trust election, or FTE. This basically means that any family member, so that's going to include grandparents, parents, brothers, sisters, children, spouses, can be beneficiaries of that trust. The trustee is commonly going to be you as an individual or individuals, or you can have a corporate trustee where you are the director of that corporate trustee of the company. Now, I typically prefer corporate trustees from an estate planning and a liability perspective. One of the key benefits and one of the main reasons that people start up family trusts is it can be very tax effective. So when you buy assets within the trust, it's up to the trustee's discretion how the income and the capital gains that are produced by that asset are distributed each year. So for example, if you wanted to purchase an investment property, you could consider doing it through a family trust. So instead of all of the net rental income being taxed by the person who is on the title, if you own it through a family trust, you can distribute the income or the net rental income how you like each financial year. So one year you might distribute a chunk to your wife, you might distribute some to the kids, and you may distribute yourself a little bit. The beauty lies in that you can change it and tweak it every single year to match the marginal tax rates that year. And it's also important to note that unlike companies, family trusts do receive the 50% general discount on capital gains if the asset is held longer than 12 months. Another benefit of using a family trust is asset protection. Generally speaking, assets held within the family trust are going to be somewhat protected from creditors and legal action. And that's why they're used a lot by people in high-risk occupations. So you'll often find that if you have a look at the personal assets of, say, a doctor or a surgeon, because it's a highly litigious industry, they often don't really hold many assets in their own personal name. Family trusts can also be great from an estate planning perspective because they don't form part of the estate. They're dealt with by the succession provisions in the trust deed. Under this arrangement, if you were to pass away, assets can continue to be held by the trust. So there's no need to sell down the assets, no need to change the ownership, and this is particularly good if you have a corporate trustee. But what this allows you to do is it allows you to manage the tax implications very well for the beneficiaries. Also, distributions can be made on an ongoing basis. So this avoids the need to have to distribute a large sum of money to a beneficiary where you think it might not be appropriate. So for example, if you have an adult child and you want to gift them some money if you were to pass away, but they don't quite have their life in order and you worry that they're going to misuse the money or it might ruin their life, well then, using a trust, you can limit the amount of distribution that goes to them every single year. If you have a complex family situation or a blended family, then again, a family trust can be great from an estate planning perspective because it can make sure that, or help to make sure that all the beneficiaries are treated fairly and equally, particularly if you think that it might be a situation where the will be contested. So as you can see, there are a lot of benefits of using a family trust, but before you get too excited, let's consider some of the downsides. Trusts can be expensive to set up and maintain. Each year, you're going to need to lodge a tax return for the trust. Therefore, a trust is not cost effective for small sums of money. If you hold existing assets and want to transfer the ownership to the family trust, there will be capital gains tax issues and potential stamp duty considerations dependent on the type of asset. Family trusts can't distribute a loss. This can be particularly tax inefficient where the trust also has franking credits that it wants to distribute, but can't due to the tax loss position. While tax losses can be carried forward, the benefit of the franking credits will be lost. All profits should be distributed out of a family trust. If retained in the trust, they'll be taxed at the top marginal rate. Before distributing money out to a beneficiary, you need to consider what implications having additional assessable income will mean for that beneficiary aside from the obvious tax payable. For instance, special consideration needs to be put on the impact it could have on social security benefits, such as the age pension, or if there is a HECS step, this could increase the mandatory repayment. When distributing money to children below the age of 18, you need to be aware of the minor tax rates. You should consider the implications of Section 100A of the taxation ruling, which deals with reimbursement agreements. It may be considered tax anti-avoidance, where lower or concessionally taxed beneficiaries of a trust are made entitled to the trust income by the trustee, while the income is enjoyed by another person who would otherwise have to pay more income tax. So there you have it, a quick crash course in family trusts. Now, today we really did just scratch the surface. There are a lot more topics we could have talked about, such as owning a business through a family trust or using a bucket company, but I didn't want this video to get too long. So if you think a trust might be beneficial for you, then I would suggest seeking professional advice just to make sure that you're on the right track. And if you want our help, feel free to reach out to us through the website. But that's it for me today, guys. If you learned something new in this video, then please give it a thumbs up and I will see you guys in the next one.